And welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way for you to defer capital gains tax on the sale of highly appreciated multifamily syndications, save a failed 1031 exchange, cryptocurrency, primary homes, all so you can create and preserve more wealth. Hey, we're also streaming on Expert CRE Secrets podcast as well, where we bring on expert commercial real estate professionals and operators and investors. And so I'm excited to have our next guest. And by the way, I'm Brett Swarts, and I'm the host of all of this, and I'm hoping you're going to gain a lot of value in our conversation today. I'm excited about our next guest. He's a former management consultant, startup owner, and corporate executive. He turned it to a full-time real estate investor and operator. He has achieved financial freedom and is now on a mission to empower others to do the same through multifamily investing. He's out of the great state of Indiana. And please welcome to the show with me, Kent Ritter. Kent, how you doing?
Hey, Brett, I'm doing great. Thanks for asking.
Absolutely. Excited to get to know you a little bit more on the podcast here and share some expertise about multifamily syndication and how to essentially be passive and invest like a pro with someone who is a pro in Kent Ritter. But before we get into that, Kent, would you give us a little bit more about your story and your current focus?
Yeah, absolutely. So, you hit on the highlights, right? I was a management consultant out of college. I spent 12 years doing that. And really what management consultants do is we fly around the country and we help companies solve problems that they can't solve themselves. So it was a really good kind of masterclass in just seeing hundreds of different businesses and how they operate and what works and more of what doesn't work. But it really gave me a solid understanding of those themes that drive businesses to be successful or to fail. And so I think as I moved into starting my own business and then moved into real estate investing, that has really served me well, understanding those levers that you can pull to really drive profitability and drive the success of a business. You mentioned starting my own business. So a few years into my consulting career, a few of my colleagues and I left to start our own boutique consulting firm, really just niching down into some specific technologies that we felt were going to be the next generation. We caught the wave at a great time. We grew that from 5 guys literally around a kitchen table to 95 employees and about 30 million in annual revenue in 5 years. And we sold that at the end of 2015. That's what really started my real estate career. I started it really just looking to deploy capital, looking to diversify my investments and wanting to not have all my eggs in one basket in the stock market. And so I started looking at alternatives, and it started out as something that was very personal to me of just trying to build wealth for my family. But as I got into it more, I really fell in love with real estate and fell in love with finding properties and the process of going through a transaction and really being able to identify undervalued properties and create something new, create something fresh, improve the property, improve the neighborhood. Really love and enjoy that process. And I had a fair amount of success in doing that, and to the point where I felt like I could, the entrepreneur in me felt like I could, go out and start a business in doing that and not just improve my own financial situation, but start to add value to others and create investments that others could invest in, which most people don't have access to or don't even know about. I really didn't until I started kind of diving into this world in about 2015. So now I run Hudson Investing, which is it's a private investment firm where we invest in multifamily real estate, and we bring in investors to invest alongside us to do that. And when doing that, we're fixing up properties, we're renovating. So it's like, I tell people, it's like what you see on HGTV. We're just doing it 100 units at a time, and we're holding them for about 3 to 5 years, and we're paying out the cash flow on those deals back to our investors. And then when we sell, we all share in the appreciation. And there's some huge gains typically that occur in that if you do it right. And so coming on and figuring out how to keep most of those gains and shelter those capital gains, I think is very relevant to me and all of my investors. So happy to be here today.
Absolutely. Kent Ritter, that's amazing. I love that background. And by the way, you can learn more about Kent Ritter at kentritter.com. By the way, it's Ritter spelled Ritter. If you're not watching this on YouTube, that's kentritter.com. Amazing. We're going to dive into that journey and some of the top secrets to investing passively in multifamily, the world with you, Kent. But before we go there, I want to take one other step back. And I want you to go back and picture yourself in high school or college, right? The earlier days. You see, I believe we've all been given certain gifts in this life. Some people call them superpowers. Some people call them strengths. I believe they're God-given gifts, and they've been given to us to be a blessing and help to others. So I'm curious, what are those one or two gifts that maybe you believe you were given, and how does that help how you help and bless people today?
Sure. So my gifts, I think one of my gifts that is kind of proven valuable over and over again in my career, especially kind of launching businesses, is just the ability to. I was actually told about this. I didn't recognize it, but the ability to take complicated ideas and distill them down into something very simple. And I think that's extremely important when you're running complex projects or have complex investments, and the ability to make it something that's easy to understand, that people can get excited about and get on board with, and get everybody moving in the right direction.
That's a great gift, especially in today's world, right? With a lot of competing ideas and different things that are coming at us, right? To be able to distill what's important, and even if it's a little bit complex, and making it simple. And so now you've been able to maybe take that and do that with multifamily investing. I imagine that's also a part of your training and how you were mentored and coached in the project management, right? And having that extensive knowledge and built up. I think that's really cool. So is that a fair summary so far?
Yeah, that sounds right.
Excellent. So now let's dive right into the topic, which is all things multifamily investing. So what's the biggest kept secret when it comes to passively investing in multifamily deals, Kent, that you like to share with the audience?
The biggest secret is probably just that you can do it, and almost anybody can do it. And there are, these deals out there through a syndication format, which is essentially what a syndication is when a group of people pool their resources together for kind of a larger common goal, right? So in this case, it's to purchase a bigger, better property than any of us could do individually, right? And that these investments are out there, and these investments commonly return, 2, 3, even higher than that, X, what you would typically see in the stock market traditionally. And it was eye-opening to me, who fancied myself a pretty savvy investor. I've invested actively in the stock market for probably 15 years at that point, and in other types of investments, startups and things, but had never heard of this idea. So when I thought real estate, I thought, the only thing I'd ever been exposed to was you go out and you buy a single family and you become a landlord. And that never really appealed to me. But when I learned you could actually invest with experts and invest right alongside them as they're putting their own money in, and get these type of returns. I mean, a lot of my investors, the first conversation, they say, "Oh, these returns are too good to be true." I just tell them they're not too good to be true. You're just not used to it. You just haven't, you're just fed the marketing of, the 401k groups and kind of the traditional paths. And, so they're just not exposed to it. And once you're exposed to it and you understand the power, I mean, for me, it's been life-changing. I was able to create a business out of it, grow my wealth substantially in the past 5 years beyond what I could ever do in the stock market. And so that's why I really am just trying to tell as many people about that this is an option, and that you should be diversifying. If you look at the richest people in the world, I mean, their typical allocation for real estate is somewhere in like the 20 to 40% range. And when you look at a lot of kind of just normal individuals, right, most of their allocation in real estate is zero. And so I just asked the question of, well, if it works for the richest people in the world, why wouldn't it work for you? And I think it does for everybody.
I couldn't agree with you more. And, growing up in the real estate industry with my mom and my dad, rentals and development, and in the Bay Area, I saw firsthand the ability to grow wealth, and then being able to go to Marcus and Millichap and start studying how to underwrite properties, how to make sense out of properties, how to sell properties, how to broker deals. I fell in love with multifamily at a young age. And once it clicks, it's almost like, you can't unsee what you've seen. The ability to raise rents and help provide housing for people, which is, to me, we're in a housing crisis, right? We're all in a housing crisis, right? And be able to make it as affordable as you can, especially if you're finding value add, forced appreciation opportunities. So I'm curious, what's the best secret for you guys to be able to find those deals? Because it's super competitive right now. So where are you looking? How are you uncovering those deals for your investors? And maybe you can talk a little bit about some of the average returns that you've been able to achieve?
Yeah, happy to do that. So, I'd say there's no secret, right? There's two main channels in the ways that we find deals. One is through our broker relationships. So through relationships that we've built over, the last 4 or 5 years with individuals, with brokers, that we built up a trusted relationship, showed that uh, we can make a transaction a smooth process. We can approach it very professionally, and that if we get a deal under contract, we're going to close. That's the most important thing to a broker. So I think once you prove that and you gain a track record, then the deals start to come to you, the good deals. The other one is which we've implemented more recently, is a direct to seller strategy. We've had success going direct to sellers, and building relationships with them. And then when it's the time for them to sell, we're one of the first groups that they look at. And now that's definitely a longer term strategy. You want to build relationships over a long term, but I think all of this is really driven by relationships, and there's no like quick, easy secret to it. It's just good networking, good relationship building, showing people that you're going to do what you say you're going to do. And over time, you build up a track record in that.
Fantastic. And so maybe you could talk a little bit about some of the deals you're seeing, some of the cap rates you're looking at, some of the potential returns.
Sure.
It seems like it's tighter and tighter these days with quality opportunities, a lot of competition. So what are you seeing? What are you underwriting? And give us a little bit on the nuts and bolts of the numbers.
Sure. So, yeah, it's absolutely a seller's market right now. I think everybody has to recognize that, and in that market, it is more competitive to buy. I think it has become harder to find good deals that really pencil out and where the math works. But at the same time, we're seeing, you mentioned the housing shortage earlier. It's the same thing on the multifamily side. There's just a shortage of places for people to live. And because of that, we're seeing tremendous rent growth. To the tune of, in Atlanta, 26% rent growth. Same things in Phoenix and in other markets. Even in Indianapolis, where I am, there's examples of that. There's properties where rent has grown 30% this year. Overall as a market, we're seeing about 10% rent growth. Which is unprecedented. So we're seeing unprecedented rent growth across the country, which is driving up values as well, right? So we're seeing some substantial appreciation. It's great if you're a seller. It makes it a little tougher if you're a buyer, but it's just the part of the cycle that we're in. And for us, from an underwriting standpoint, I think the balance is, how much do we factor in kind of what's happening currently versus moving back to historic averages as we make our assumptions. And I think that's the art in the process. And that's where just the experience really plays in, and the boots on the ground experience of owning properties in these markets and seeing what's happening day to day. I think that makes us, it's just a much different perspective than if you're coming in and trying to buy in a market for the first time. And so, it's really just kind of being driven, kind of just all of that coming together to be able to make good buying decisions, and for us, you really can't look back and say, oh man, I would have paid this amount a year ago if I would have bought that and therefore not move forward. You could always say that, right? But you didn't buy it a year ago. You're looking to buy it now, and do the numbers work now? And I think where a lot of people get stuck on is that historic mentality. And I think for us, you got to look forward and say, okay, do the numbers work now, where prices are now? And when deals do, we move forward very quickly and can transact very cleanly. And I think that's what's been setting us apart. As far as cap rates, cap rates have continued to compress across the entire country. If you're in a market like Dallas or if Phoenix or Orlando, some of the hottest markets in the country, you're going to be buying things that are in a 3 cap range. If you're in markets like Indianapolis, which has seen its own growth in and of itself, but the Midwest has always kind of lagged, you're still going to be in the 4 cap range. So, I hear people oftentimes talk about, oh, I would never invest. I would never buy a 4 cap. I would even never buy a 5 cap, 6 cap. Like, it depends. Each year, it moves, kind of down for people. But that's not the right approach, because cap rates are not good or bad. I think some people look at low cap rates as a negative thing. They're not good or bad. They just are what they are. And you have to adjust your strategy based on the environment, right? Just like anything else. In a low cap rate environment, for every dollar you put in to the property and therefore increase NOI, you're increasing the value of the property by a higher multiple. In a 5 cap market, for each dollar of NOI, you increase the value of the property by $20. In a 4 cap market, for every dollar, it's $25. So, you're really able to, in a market like this, drive appreciation. And that's really how you create wealth. If you're really focused on creating wealth, you don't create wealth through cash flow. Cash flow is great. And if that's your goal and you're trying to supplement income, or it's your fixed income, maybe you're retired and you want some additional cash to live on, then cash flow is great. And these properties typically put off between 7 to 10, 12% cash flow annually. But appreciation is how you get rich, and that's how you build wealth. And so I think you just have to, again, match the strategy to the market and the market cycle. And if you can focus on good appreciation in a market like this, then you can come out on top as an investor.
I absolutely love it. I was just in Florida last weekend, touring a property, Class C property in like Orange Park, Florida, just kind of 20 minutes south of Jacksonville. And the year-over-year rent growth was over 17% in the Jacksonville area. People flooding from California, from states like New York to Florida or Tennessee, Texas, Arizona, perhaps even Indiana, Alabama, right? What are you seeing as the top markets that you're looking in? And perhaps even mention, what are some of the markets you own in now?
Sure. So we focus primarily currently in Indiana, Ohio, and Kentucky. So we have properties in Indianapolis and Louisville, Kentucky, Lexington, Kentucky, and in Dayton, Ohio. And we like those markets. They're very solid growth markets. They're good cash flowing markets, and they're seeing their fair share of appreciation. I mean, we have a property in Louisville that we bought about a year ago for $80,000 a door, and we've been getting offers on it unsolicited for 110 to 115K a door. So, I mean, you don't have to go to the Atlantas or the Phoenixes of the world, the top markets that are hitting everybody's radar, to see that type of growth. I mean, we're seeing it here in the Midwest as well. And I think we're benefiting from many of the same factors and dynamics that you just outlined, right? We're seeing a move to remote work, right? We're seeing a move away from the coasts. And Indiana has a surprising, especially Indianapolis has a surprisingly large tech, especially when you talk biotech industry that's based here. And that on top of just being centralized in America. And, there's a stat about Indianapolis where you can reach something about 75% of the continental US within a day's drive. And so from a logistics standpoint, we're us and Louisville, especially, and all through kind of the corridor here, are major logistics hubs for places like Indianapolis has the second largest FedEx port in the world. Louisville is the North America headquarters, their world port for UPS. And then you have Amazon and Walmart and everybody else that's kind of, congregating here in this area because of the ease to get to the other parts of the country. So I think we're benefiting from all those factors and trends.
Fantastic. I love the breakdown of that, and that gives us some intimate knowledge of those areas. Indiana, Kentucky, Ohio. I can't pass it up. So I played hoops and basketball. It's my passion, man. If I could play every single day for the rest of my life, my knees didn't fall apart, I would. So I'm curious, is it go Hoosiers? I mean, is that like default, or where do your loyalties lie?
Well, I went to IU, so absolutely it's go Hoosiers. But even before that, like just as a kid in Indiana, you grow up loving IU basketball. I mean, I grew up on that stuff, on Bobby Knight and all the stories. I've been watching it since I was a little kid. So it was pretty much a done deal that I was going to attend IU. They just happened to have also a great business school, so I was able to get a good education while I was there watching a ton of basketball.
Fantastic. It's on the bucket list, right? And so I want to go see an Indiana game. I want to see a Nebraska football game. I want to see, Alabama football game, that area. In California, you have USC, SoCal, right? And some other Pac-12 teams, but it's not like, let's say the East, right? Especially basketball like Indiana. But anyways, that being said, let's shift a little bit. We're going to move into the section of capital gains tax deferral and maybe some challenges that you face as a multifamily syndicator or frustrations with the 1031 exchange. So the part of the show, I'll start with this question. What's been the biggest frustration that you've seen or you've experienced with yourself or your clients when it comes to 1031 exchanges or lack thereof options for folks who are selling highly appreciated assets that maybe want to invest in multifamily deals with you and or when you're exiting deals?
Sure. So just speaking of 1031 exchanges specifically, I mean, I think the hardest thing with the 1031 exchange is the timing. And I get a lot of questions. I get a lot of questions about that. People come in and saying, "Hey, I got this 1031. Is there something I could invest in?" My first piece of advice to folks is like, don't let the tail wag the dog. Don't get into a bad deal just because you wanted to avoid taxes. I mean, especially we're probably in the lowest tax environment that we'll be in for quite a long time. Sometimes it's better just to pay those taxes and move on than put yourself in a bad deal just because your 45 days or whatever was running out. But I think that I think that one is just the timing and trying to fit the pieces together, right? I think two, a lot of people ask, can I invest in a syndication with my 1031? I think there's sometimes a misconception that you can, and you can't direct. Like a 1031 is a like kind exchange, right? So it's like if you sell in real estate, you need to buy real estate. Investing in a syndication doesn't quite get you there. You can with a tenant in common structure, but it's just it can be a little more difficult to set up. It's absolutely doable. I mean, my answer for folks is typically, if it's a larger dollar amount and it's a meaningful amount of equity for me and my deal, I'll go jump through those extra hoops to make it work. But you can't just easily get into a syndication and go passive through a 1031, in my experience.
Yeah, and do you have any like horror stories where like someone calls you and it's like, it's day 46, or maybe it's on the other side. You're like the seller and you're like, "Hey, oh, they've got just 4 days to identify. Oh, wow. Well, in that case, my counter offer is X." Like, any other thoughts around that 1031, shotgun wedding, got to get engaged in 45 days, married in 180?
Well, I mean, as far as negotiations go, I mean, just the more information you can understand about the sellers or the buyer's position, then you can use that information to your advantage, right? I
Mhm.
mean, that's so obviously you would want to factor those things into account as you set your price. Um, as far as I get asked all the time by folks, or maybe folks through Bigger Pockets or other forums, saying, "Hey, I've got 2 weeks left to identify. Are you aware of any properties?" And that's when I give that advice, like, look, you're probably not in a position, if you're in California or somewhere, to come to Indiana and invest and make that successful in this type of hurry. In that environment, it may just be good to just pay those taxes and move on. What I do tell people is, you can effectively reduce a lot of those capital gains without a 1031 by just buying or investing in another passive asset in the same calendar year that you're selling. So in our syndications, we do what's called a cost segregation, where we're breaking down the components of the property into their specific elements. For example, a multifamily property depreciates at 27 and a half year schedule, just flatlined. So that's one way to approach it. If you do a cost segregation, you actually break the components of the property down, right? For example, the carpet in the apartment, how much is that worth? And that carpet depreciates at, I don't remember, it's either a 5 or a 7 year schedule. So it's a much more accelerated depreciation schedule, right? And because of bonus depreciation, you can actually accelerate all of that 15 and less year depreciation up to year one. And so typically in an investment, when we're doing a cost seg, which is almost every investment, we're able to offset anywhere. Like if you're investing for round numbers, $100,000, we're typically giving you about $60,000 to $70,000 in depreciation in that first year. That again can offset other passive gains that you have. And so you can achieve the same goal of saving on taxes, sometimes with avoiding that whole 1031 roll around.
Yeah, I could agree with you more, right? Having cost seg and being able to get new depreciation schedules and invest in assets that have that is an advantage. So a couple thoughts on that, right? So one, we call it the shotgun wedding, right? We couldn't agree with you more, Kent, in that you don't want to let the tax tail wag the investment dog, right? And in fact, that's part of why I started Capital Gains Tax Solutions. I was at Marcus Millichap in 2006. Things were going great. Everyone loved to be a 1031 exchange, a seller. But as soon as they were a buyer, a lot of them were overpaying. And then all of a sudden, when the music stopped, someone had too much debt, not enough liquidity, not enough diversification. And I had one particular gentleman we were speaking with, and we were telling him, sell, sell, sell. Everything's at the peak. He didn't sell. He had $50 million of multifamily investments. He was leveraged pretty high. He lost everything. Within a 3-year period, everything was gone, went bankrupt. And part of it's because he was doing this 1031, just roll it. And he put himself in too much leverage, and then he lost it all. And we said, there's got to be a better way. And then we figured out a better way, and it was called the Deferred Sales Trust. And it actually enables you to sell high and buy low whenever you want to, not using a 1031 exchange. And we call it the Netflix way of doing things. It can save a failed 1031 exchange. It works for cryptocurrency. It works for primary homes. In fact, we partner with and work with other syndicators that are having assets and opportunities to invest in. And it's cool because it's not IRC 453. You're not tied to that 45-day sprint and the 180-day close. It's IRC 453, which is an installment sale type of method. And so it's now available. By the way, if anyone wants to learn about that, they can go to capitalgainstaxsolutions.com. We're closing about a deal a week, and it's transformational for people, especially if they want to get to the passive side and they don't want to be so active, and especially if they have cryptocurrency and they're wanting to get into a real estate investing. You can check it out at capitalgainstaxsolutions.com. But that being said, Kent, as you're doing deals, when you exit finally and you've depreciated that asset, right, and you've done that cost seg, guess what? All of that recapture and all of that tax is going to be flooded in, and you're going to get hit. So what is the exit plan when you go to exit your syndications to defer the tax?
Well, the best exit plan is to have something else to invest in, right? I mean, you continue to roll that money forward. And I think that's kind of the simplest answer. I love to be able to exit a property. We just sold a property here in June. Property I had down in Atlanta is a great return, about 25 IRR back to our investors, and have another property ready to go for them to invest right back in.
Got it. But the tax is paid at that point. And that's where most people find us, and then they figure out how to do this, and it changes things. But right now what you're saying is you're just selling and everyone's just paying the tax, but then you're trying to get another deal with a new depreciation schedule to do that cost seg and maybe wipe it out. Is that the strategy right now?
That is the strategy. You seem to have another option. Please do tell.
Yeah. So that is the Deferred Sales Trust, right? So I'll give you just kind of 2 deal stories, right? And that deal story is a gentleman, like you guys, there's 2 guys named Dave and Jordan, they're clients of mine. A $20 million multifamily asset. They're the 2 GPs and lots of LPs, and they're selling it in Las Vegas. And they sold and were able to put their GP positions. The whole entity doesn't have to move. It's very flexible. They deferred all of their capital gains tax. If the other investors are smaller, they just pay their tax like they normally would. But the Deferred Sales Trust allows total flexibility for partnership separations. Then they did another deal, $16 million multifamily property in Phoenix. Same thing, rolled those funds into the trust. Then they kind of have this I call it the war chest, right? Where the money is tax deferred, it's liquid, it's available. Then they can partner with the trust, and they went and bought a multifamily property in Dallas. And so instead of paying that 30 to 50% in depreciation, recapture, and capital gains tax, you're able to defer it, but have no timing restrictions, have total flexibility, be able to get out of debt, no like-kind debt replacement requirements. We got to be careful with mortgage over basis, which in that scenario, we're doing a partial Delaware statutory trust to take care of that debt over basis issue. And sometimes we even have clients do partial 1031s, right? Because 1031s are great if you can find a deal that makes sense. But let's say you're selling 100 units for $10 million, and you find the perfect $6 million deal, right? 60 units, just to keep it simple. Well, there's $4 million of boot. Why not do a partial 1031 exchange and then the other partial deferred sales trust, right? So you can have a little bit of both. The key is defining what your tax liability is. 2, figuring out a good outcome of what you're trying to achieve. And then 3, executing on the plan, right? But you got to do this all in advance. And so, yeah, it's called a deferred sales trust. We think it's the best kept secret. A lot of people get it confused with the Delaware statutory trust. But yeah, any thoughts on that?
I don't know much about it, but it sounds like it could be a good option. Definitely interested in learning more.
Cool. Thanks. And that being said, you ready for the lightning round?
Sure.
All right. Knowing what you know now, Ken, if you go back to your 25-year-old self, what's the one golden nugget you'd make sure to... We had a little blurb there. So what's the one golden nugget you'd make sure to tell yourself to do?
To my 25-year-old self, I would have started investing in real estate a lot earlier. I started when I was like 31, If I would have started when I was 25, I wish I would have started when I was 19. I'd be a heck of a lot farther than I am today. But it'd be start investing in real estate, do it through a house hack, buy a duplex, live in half of it, rent out the other half, learn how to be a landlord, and get somebody to pay your mortgage for you.
So Rich Dad Poor Dad is a big part of all the multifamily syndicators, commercial real estate world. So what's the one thing that you try to practice out of the Rich Dad Poor Dad strategy in your business investing, in your multifamily investing?
Man, I guess just be an owner and be an investor. I mean, don't be you know try not to put yourself in a position to be an employee, and put your assets to work for you.
Beautiful. Next question. What's the number one book you've recommended or gifted the most in the past year?
Number one book I've recommended. Probably that's a good question because there's a few books. Probably in the past year, yeah, definitely in the past year would have been Adam Grant's Think Again, and it's really about just challenging your belief system and being open to changing your beliefs based on new information. So just the idea that we're constantly learning new things. Why should we believe the same things we believed 10 years ago when we're constantly learning new things, and we should be adjusting our ideas based on that. And there's a really good quote that kind of sums it up. It's a Ray Dalio quote in the book, and it's like his quote was, if you can't look back each year and say, "Wow, I was really stupid last year," then you really haven't learned a whole heck of a whole lot.
Love that. I'm reading Ray's book, by the way. And I read it to my kids. It's called Principles of Success, Principles for Success. He has a big book, but then he has the kids version. But I mean, to me, it's an adult version too, because it breaks it down.
Yeah.
Amazing. I wish I would have introduced to Ray a long time ago, but I absolutely love that quote. Next, second to last question. What are you most curious about right now?
Man, that's a good question. I'm curious about a lot of things. One thing that I'm most curious about, honestly, is what happens. I think I've got a pretty good vision into the next 18 months to 2 years on kind of what happens in multifamily, what happens with housing supply, what happens with interest rates, and all the things that impact the world that I live in. Outside of that, I mean, it gets a little hazier. You start thinking about, a new presidential election. You start thinking about the Fed raising interest rates, the money out there that continues to be printed, and what's going to happen. And I wish I had my crystal ball. I wish it was a little more clear.
Yeah, all the more reason to invest in multifamily real estate. That's value add with good operators like yourself, in areas that are pro growth, pro business, right? And yeah, so that's I'm also curious about those same things. Last question, Kent, and then we'll let you go. After all your success, investing, coaching, helping others, helping investors, how do you stay centered in your values, and how do you stay encouraged to charge forward to reach new heights?
Man, that is a good question. So how do I stay centered? Well, I do a lot of things just on a personal level to stay centered, from meditation and journaling, and kind of just making sure there's clarity of thought, and just a focus on what's important. I think quarterly goal setting is extremely important, and not overcomplicating things with like 10 goals, but like I try to have like 3 goals each quarter. If we accomplish these 3 things, it's going to push our business forward. So I think keeping things simple in that way, and and just getting back to your why on everything. So I often remind myself, it's very easy to remind myself why I do what I do, because I'm down in the basement right now in my home office, and they're just upstairs running around. I can hear their footprints. But everything that I've done really has been for my kids and for my family, and this journey really started with setting up a secure financial future, but also a financial future where I owned my time, and I could be the kind of dad that I wanted to be, and spend that time with my kids and have that flexibility. And so, everything that I do kind of comes back to that, and it's gotten bigger than I ever expected, right? I told you about that journey, from a very personal journey to now running a business where we've, acquired 8 properties, and we have, hundreds of investors. But still, like the tenets remain the same. Now it's about giving others that financial freedom and that time freedom, so that the idealist in me has the idea of if everybody has the choice to do what they want to do versus what they have to do, and being shackled to, a job maybe they don't like, or not having, not having enough income or the savings, or the wealth that they would like. If we all had more of all that, or more freedom, then we could all do more of what we want to do. And in that way, we'd all be a little bit happier, and it'd probably be a better place to live. So that's kind of the ideal vision of why I do what I do.
Absolutely amazing. Kent Ritter, I want to thank you for being on the show. Thank you for sharing that. Thank you for sharing a wisdom about the multifamily market, about leadership, about vision, and about growing your company. I want to encourage you to keep using the ability to take what's complicated and making it simple, and then helping others to get freedom through multifamily investing. Kent, for our listeners who want to connect with you, can you remind them one last time what's the best place for them to find you?
Yeah, so you can go to kentritter.com. I mean, that's my home base. You can access my podcast, my blog. It's really set up to be a resource for passive investors. So if you're thinking about making your first investment, it's a great resource with FAQs and definitions and things, just to make it a little easier to take that first step. Outside of that, check out my podcast. It's called Ritter on Real Estate. And again, it's set up to really be a resource for folks that want to invest in real estate. A lot of them are busy folks that don't have time to do it themselves, but they still want that diversification.
Kent, thanks for being on the show. Thanks for being here. And I want to thank our listeners also for listening to the episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way for you to defer capital gains tax on the sale of highly appreciated businesses, real estate, save a failed 1031 exchange, cryptocurrency, all so you can create and preserve more wealth and have some more of this freedom that Kent's talking about to do more of what you want to be doing and you should be doing with the gifts and talents you've been given for your family, for the community. And so we want to encourage you to go to capitalgainstaxsolutions.com and to learn more all about the Deferred Sales Trust. Hey, thanks so much for listening to this. You also might be listening to this on CREsecrets.com. I want to encourage you as a real estate professional, investor, broker to continue to dig in and increase your value proposition. You can check us out at CREsecrets.com if you want to learn more about that. Thanks everyone for listening. Please rate, review, subscribe. Please share this with somebody you can encourage today, and go